Hello and welcome to the fourth episode of the Special Situations Report podcast, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. In this podcast, we'll dive into the latest M&A activity, upcoming spinoffs, significant buybacks, unique insider buying, activist campaigns, and more.
My name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area. This week, we will briefly cover two hostile acquisitions and the use of poison pills by their boards to fend off the hostile acquirer. We'll also discuss the latest M&A developments with the US Steel and Juniper Networks acquisitions, the Western Digital spinoff, buyback announcements by Comcast, the home builder Pulte Group, and the packaging company Ball, as well as insider buying at Adobe and TKO.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
So let's get started with M&A activity. In the very first episode, we mentioned that the US Steel Nippon Steel deal is likely dead when the Biden administration blocked the deal. But this week, Ancora, an activist firm, mentioned that they want US Steel to drop the Nippon deal and are proposing 9 directors to the board of US Steel. What is interesting about this request is that they only have a 0.18% stake in the company and are speaking up. In contrast, the merger arbitrage focused firm Pentwater Capital, who owns a nearly 9% stake in US Steel, supports the current board and wants the acquisition by Nippon Steel to go through. Pentwater Capital is an arbitrage fund that we've been tracking for quite some time now, and they tend to hold concentrated positions. And as of their last 13F filing, they had nearly 20 million shares of US Steel, representing a little over 7% of their portfolio. This is a hedged bet for Pentwater Capital because they also own put options on US Steel. So just in case the deal does not go through, the downside risk from them will be not as much as somebody who is in US Steel without a hedged position through put options.
Yeah, this week has been anything but easy in the merger arbitrage landscape. In January 2024, Hewlett-Packard Enterprise announced a plan to acquire the network products and services company Juniper Networks for a little over $14 billion, or around $40 per share in cash. Almost exactly a year later, the Justice Department announced that it has sued to block the acquisition, claiming concerns surrounding a possible loss of competition with Cisco Systems. While there are several smaller companies that also compete in the market, the Justice Department considers HPE and Juniper to be the two primary drivers of innovation in the market and believes Cisco will lose significant competition if they combine. The problem is related to both companies' enterprise wireless network segments, which Juniper got access through their acquisition of Mist in 2019 for $450 million, and HP Enterprise got access through their Aruba acquisition in 2015. One potential remedy could be the spin-off of this division to satisfy the DOJ, but both companies have already issued a joint response following the DOJ's legal action aimed at blocking their merger.
Yeah, it remains to be seen if the new DOJ appointee by the Trump administration that is going to cover antitrust would be open to such a remedy where they can spin off of a division. At this point in time, the market seems to have some level of confidence that this might happen because the stock is only trading at a little below $35 a share. 6 of the 7 concentrated merger arbitrage funds we track had a position in Juniper Networks, and 5 of them added to their positions based on the last 13F file for Q3 2024. It's already been several months since that filing came out, but as you know, 13Fs are filed 45 days after the end of a quarter. And so in the next couple of weeks, we'll find out more about what's happened to this position for those funds. The deal has already been approved by the European Union and UK's Competition and Markets Authority, the CMA.
Let's wrap up our M&A section with a quick overview of a simpler deal. Aspen Technology, an enterprise asset performance management company, is set to be acquired by the technology and engineering giant Emerson Electric for $265 per share in cash, which gives Aspen an implied enterprise value of $16.8 billion. This deal represents a slight premium from Emerson's initial offer of $240 per share, which is quite typical of most M&A deals. You'll often see the initial price bumped up slightly by the time the deal is finalized. Emerson already owns 57% of Aspen Technology after a deal in May 2022 where Emerson's industrial software businesses were combined to create the new Aspen, a global industrial software leader. Given the stake that they already own in the company, Emerson is only paying about $7.2 billion to acquire the rest of Aspen, and after the transaction closes, Aspen will operate as a wholly owned subsidiary of Emerson.
So we had been tracking the Aspen potential deal in our Deals in the Works tool, and there are 3 other deals that we want to talk about this week. QXO, a technology solutions company for the building products industry, wants to acquire Beacon Roofing Supply, a distributor of roofing materials and building products. QXO approached the board with an offer of $124.25 per share in cash, valuing the company at $11 billion. But the board rejected the offer and claimed that it undervalued the company. Shareholders weren't exactly informed that this offer was on the table. And so what QXO did was they went directly to shareholders and launched a tender offer to acquire shares at $124.25 per share, with the tender offer expiring on February 24, 2025. I think the stock is trading a little below $120 per share, and so that this is still an opportunity for arbitrageurs or other investors to potentially get involved in this deal. In response, Beacon adopted a poison pill plan that triggers if someone acquires more than 15% of the company without approval. Why is QXO so aggressive? It is headed by Brad Jacobs, who previously spent a decade at United Rentals and then built XPO through a series of acquisitions. Eventually, XPO split into 3 different companies and there were spinoffs involved. He also invested $1 billion in a software company called Silver Sun Technologies and renamed it QXO in June of 2024.
Now, another company that is in the middle of a hostile takeover battle is Barnwell Industries, a tiny microcap company that focuses on energy exploration in Canada, owns land in Hawaii, and also has water drilling operations in Hawaii. Ned Sherwood and his firm, the Sherwood Group, which already owns 30% of Barnwell Industries, is trying to take the company private. In response, Barnwell adopted a poison pill plan that triggers the 20% threshold. The Sherwood Group's 30% position is already grandfathered in.
So it's fascinating to see that 2 different companies are adopting poison pill provisions. So we should talk a little bit about poison pill provisions. These things are called shareholder rights plans, and they allow all investors, except for the ones making the hostile bid, to acquire additional shares at a discounted price. There's usually a threshold at which they trigger the poison pill. For example, if a hostile investor of a company acquires more than 20% of the company. What this does is it dilutes the stake of the hostile bidder. And while it might not appear fair and sometimes helps management and board members become entrenched, like for example, the Barnwell Group Industries insiders probably and management team probably love being in Honolulu, Hawaii, the courts have usually upheld any challenges to the poison pill provision. The origin of the poison pill probably goes back to the leveraged buyout days of the 1980s, when corporate raiders like Carl Icahn struck terror in the hearts of corporate boards. In fact, in 2012, Carl Icahn had built an almost 10% position in Netflix, and Netflix adopted a poison pill provision. And the threshold to trigger the poison pill was anyone acquiring just 10% of the company. The classic movie Wall Street, which if you haven't watched, I would highly recommend checking out, starring Michael Douglas and Charlie Sheen, captures some of the sentiment towards corporate raiders in the 1980s.
Poison pill plans do sometimes work out in the favor of shareholders. The software company PeopleSoft adopted a poison pill provision, but that didn't stop Oracle from eventually acquiring the company. Shareholders benefited though, as Oracle ended up paying 66% more than their original bid for PeopleSoft. PeopleSoft's founders went on to found Workday, the cloud-based financial management, human capital management, and student information system, which went on to be one of Oracle's main competitors.
When Elon Musk first tried to acquire Twitter, they adopted a poison pill as well. I used to be a shareholder in Twitter before the deal came about, and I was surprised to see them do that because it felt like the $54.20 share offered by Musk was actually quite fair. But the board eventually agreed to let him acquire the company. Right after they did that, he got cold feet and attempted to walk away from the deal. But as you and I know, once there's a definitive merger agreement, you can't just walk away from a deal. So Twitter sued him and got him to perform.
Speaking of hostile takeovers, there's an interesting situation developing in regards to the International Private Members Club Soho House. Billionaire Rob Burkle, who also happens to be the chairman of Soho House, offered to take the company private at a deal valued at $1.7 billion. However, Dan Loeb's Third Point revealed in a recent filing that they had taken a 9.9% stake in the company. Third Point sent a letter in which they announced they support Soho House's decision to explore a take-private transaction, but have concerns about the process and are encouraging the company to find other parties in the hospitality industry that would be interested in paying a higher price.
It'll be interesting to see if a deal actually goes through, but depending on when Third Point took a stake, it looks like there'll be a win-win for them, whether a deal happens or they get more deeply involved with Soho House. Let's switch gears a little bit and talk about spin-offs. In the early 2000s, I was building a large web-based enterprise software system, and in an era before AWS and cloud computing, we chose to back up the web servers on magnetic tapes. I still remember the 40 gigabyte tape cartridges we used to rotate offsite. Back then, 40 gigabytes felt like a lot of storage space. While having a conversation with a friend who works at one of the top 3 cloud providers, I was surprised to hear that magnetic tapes are still in use today. Mostly used for deep archival purposes because of their durability, individual tape cartridges can now store as much as 18 terabytes of uncompressed data. That's 450 times the size of the tape cartridges I used for those servers. Last year, 153 exabytes of magnetic tape capacity was shipped. 1 exabyte is a million terabytes in case you're not keeping track of data storage metrics, if you will. The conversation with my friend reminded me of hard disk drive companies that were at one point widely expected to go the way of the dodo bird and go extinct after flash drives entered the stage. This fear of being replaced by flash drives prompted one of the 2 largest hard drive companies in the US, Western Digital, to pay $19 billion in a cash plus stock deal for SanDisk in October 2015. Unfortunately for Western Digital, the fear was unfounded. Solid-state drives, which use NAND memory chips, are now available in sizes as large as 100 terabytes, but hard drives still have an edge both in terms of cost and durability.
But wait, aren't flash drives faster and better for some types of devices?
Yes, indeed. Speed of access and the fact that you don't have moving parts like the platters that you have in a hard disk do make them a preferred option for smartphones and laptops. I'm sure, like me, you probably drop your phone multiple times each week or each month. And if we had hard drives in our phones, most likely we would end up with a lot of data loss. Applications such as AI, where speed is far more important, also use a lot of flash. Due to the cyclical nature of the flash business and pressure from activist investment firm Elliott Management, Western Digital is now spinning off that division nearly a decade later after acquiring SanDisk. Hard disk drive demand is expected to grow at a CAGR of 19% through 2027, and we're already seeing a big inflection in both gross margin and profits for Western Digital. When the company recently reported results, the hard disk drive business was holding up well, but the flash business is currently experiencing pricing pressures due to supply and demand imbalance. Western Digital's spin-off guidance is for February 12th with distribution date of February 21st. Irving Tan will become the new CEO of Western Digital, the hard disk drive company. And the current CEO, David Geckler, will be heading up the newly spun out Flash or SanDisk spinoff.
Moving away from spin-off activity, let's start talking about buybacks. Last week, we discussed Netflix's stellar earnings and subsequent buyback announcement, and it seems like history is repeating itself because recently, Comcast released Q4 2024 and fiscal 2024 earnings and beat estimates on both the top line and bottom line. The company recently announced a large $15 billion buyback, representing nearly 12% of the company's market cap on announcement. Comcast has been consistently buying back their own stock, and they repurchased 17% of their shares outstanding over the last 3 years. As part of the earnings released, Comcast also announced that they are going to spin off their cable network portfolio, which includes notable names such as CNBC, NBS, USA Network, Sci-Fi, and more, and also includes digital assets like Rotten Tomatoes and Fandango. Comcast stock is down more than 28% over the last year, so we'll see if these positive earnings results and strategic moves will result in better stock performance in the future.
I don't know about the stock performance, but I know that we dropped Comcast for our internet service recently after too many outages. That said, I was actually surprised to see that Rotten Tomatoes and Fandango is owned by Comcast. I used to use Fandango many decades ago when I was trying to look for movies to watch over a weekend.
Yeah, and I think Rotten Tomatoes now is the more popular one.
Sounds like it. So the other buyback announcement this week that was interesting was Ball Corporation. They announced a $4 billion buyback, which represents 25% of the market cap. It feels like dry January where people were not drinking alcohol, and in general, declining alcohol consumption trends are hurting companies like Ball Corporation, which make packaging products. So, for example, the Budweiser aluminum can is something that a company like Ball creates.
The health insurance company Cigna also recently announced a $6 billion buyback, or roughly 7% of their market cap. The last few months have been a tumultuous time for health insurance companies, especially in regards to United Healthcare. And that's also reflected slightly in Cigna's earnings. The company has missed earnings estimates by a huge margin for the last 5 quarters in a row, and outlook for 2025 remains weak. Nevertheless, this doesn't seem to stop Cigna from buying back their stock. The company has had 4 buyback announcements over the last 5 years, and the last one was in 2023 for $10 billion. Over the last 4 years, Cigna has bought back 23% of their shares outstanding.
To round out our list of buyback announcements, the home builder Pulte Group beat on both earnings and revenue for Q4 2024, but they saw declining year-over-year growth in earnings and revenue. Considering that we are in a 7% interest rate environment, you would think that home builders will start seeing the pressure of a high interest rate environment for new home buyers. The Fed has decided to stay put and not cut interest rates now. And if the Trump tariffs go into effect, we are likely to see inflation go up, and these rates might continue to be high for some time now. The buyback by Pulte Group represents almost 6% of its market cap and is $1.5 billion. They have been buying back a lot of stock and have retired 21% of their shares outstanding over the last 4 years.
As I always like to say, let's transition over to C-suite transitions. This week, there was really only one C-suite transition that truly stood out to us, and that kind of relates back to our very first podcast episode. Because in that episode, we talked about the medical devices company Stryker that was set to acquire the smaller medical devices company Inari Medical. Now, this week, when we saw that the CFO of Stryker was set to leave, we were a little bit confused, but after looking at the bigger picture, it all makes sense.
Yeah, he's supposed to leave in April 2025, and the Stryker Inari deal is supposed to complete by the end of Q1 2025. When the deal was announced, I was surprised that they thought that the deal would get done so quickly, but the timing of the CFO's retirement seems to reconfirm that is how quickly they think the deal would get done. He had an amazing tenure at Stryker. Over the 14 years that he was at the company rose 700% actually. So the shares rose 700% during his tenure. So he's really riding off into the sunset with one last acquisition under his belt.
Exactly. We're normally concerned when we see sudden departures at the company, but this gives us a lot of time to process that the CFO is leaving the company. He's staying until April, so there's a lot of time in between the announcement and the actual departure.
Absolutely. Let's switch gears now to insider buying. We saw two really interesting insider purchases this week, and we'll start with the most straightforward one. David Ricks, a director of the software company Adobe, purchased nearly $1 million worth of stock this week.
Yeah, I have to say I'm a pretty big fan of Adobe and their products, generally speaking. I've been using their software for years now, and it's extremely well made. This purchase of Adobe stood out to us primarily due to who the insider was. David Ricks is actually both the chairman and CEO of the pharmaceutical giant Eli Lilly. He's been with the company for almost 30 years at this point and worked his way up from business development associate to CEO of Eli Lilly, so he clearly understands the business well.
A couple of my friends were discussing Eli Lilly in a group earlier today, and they felt that there's a good chance that this will become the first trillion-dollar pharmaceutical company. Lilly's market cap is already $730 billion, so the $1 trillion level is not all that far away.
Exactly. Eli Lilly has been doing pretty well for itself, and Mr. Ricks also appears to be an incredibly opportunistic buyer. And so far, his purchases have been very well timed. He last bought Adobe shares in September 2022, shortly after Adobe announced their intent to acquire Figma, though that deal eventually ended up falling through. However, since the September 2022 purchase, the stock of Adobe is still up by around 50%. His most recent purchase is more than 3 times the size of that 2022 Adobe purchase, which seems to indicate a higher level of confidence in the company's performance and stock. Mr. Rick's purchases of Eli Lilly are also well-timed. He last bought shares of the company in October 2019 for around $100 per share, and Eli Lilly now trades at around $800 per share. So incredibly opportunistic and well-timed purchases on behalf of him.
Yeah, I remember writing about Adobe when that Figma deal fell apart and the stock had dropped quite a bit. I regret not buying it at that point, but this time around with Mr. Rick's purchase, I'll be paying a closer attention to Adobe.
Exactly. We'll wrap up our discussion today with a look at insider purchases at TKO, one of the world's largest combat sports and entertainment companies.
TKO was formed in September 2023 by the merger of two massive combat sports brands, the Ultimate Fighting Championship, UFC, and World Wrestling Entertainment, WWE. But what's more interesting than TKO itself is Endeavor, a company that first started as a Hollywood talent agency back in 1995, but grew organically and through acquisitions to create an integrated portfolio of businesses and capabilities across the sports and entertainment ecosystem. Endeavor's claims to fame include the modeling agency and fashion business IMG, which runs the famous New York Fashion Week, and William Morris Endeavor, WME, the talent firm that manages actors such as Christian Bale, Matt Damon, Hugh Jackman, and more. The company previously also owned UFC prior to its sale to TKO. I have to say I'm a big fan of both Christian Bale and Matt Damon, so it's interesting to see the same agencies managing both those actors.
Yeah, so we bring up Endeavor because the company is a majority owner of TKO. There are a number of cross transactions between the two businesses, and it was announced on October 24th, 2024, that TKO would be acquiring IMG, PBR, and On Location, which is a hospitality and ticketing experiences business, from Endeavor, and a $3.25 billion all-equity deal. The transaction is expected to close in the first half of 2025, and Endeavor's ownership of TKO will grow from 53% to 59%.
A glaring question arises: why would Endeavor be shedding such large portions of its business? To answer that question, we look to the acquisition of Endeavor by the private equity firm Silver Lake, a take-private deal in which Endeavor shareholders will receive $27.50 per share in cash. I'm personally not thrilled that Endeavor is shedding these businesses and TK is acquiring them, because in some sense, TKO at this point in time, before these acquisitions, was a pure play combat sports company. And now the waters are a little bit more muddied for investors who are looking at TKO.
It's quite rare that you see merger arbitrage deals with a negative spread, especially when there are no special dividends or CVRs attached to the price, as is the case with the Silver Lake and Endeavor deal. Negative spreads often occur when shareholders are dissatisfied with the deal price and are hoping to get a higher offer. Endeavor is currently trading at around $30 per share, which represents a negative 10% spread on the deal. Endeavor and Silver Lake are able to bypass the minority shareholder vote since common stock shareholders of Endeavor don't have significant voting rights. When Endeavor went through with its 2021 IPO, the company split itself into a complex structure of 5 classes of shares. Ultimately, common stock shareholders, meaning the shares that you or I could buy on the open market, we own Class A shares, which gives us only about 0.4% to 0.5% of voting rights. Class Y shares, on the other hand, have immense voting powers, and together, Silver Lake, Endeavor's CEO Ariel Emanuel, and Executive Chairman Patrick Whitesell own 91.5% of Endeavor's voting stock.
This is one of the issues with companies that have multiple classes of shares, where one owner that doesn't own that much economic interest in the company has enough voting power to make decisions without the majority of the shareholders who own the economic interest but not enough voting power. Anyways, moving back to the insider purchase we saw last week, this was a joint filing by 3 different people. The first person was Ariel Emanuel, who's the CEO of both TKO and Endeavor. Patrick Whitesell was the second person, and Silver Lake, the private equity firm, was the third person on this filing. They're all together 10% owners of TKO, and this filing was under 10b5-1 trading plan, which means we are likely to see more purchases beyond this $34 million insider purchase we saw this week.
And if all the special situations activity surrounding TKO isn't enough, there's more. In addition to paying down debt, TKO announced a $2 billion share repurchase program in October 2024, representing about 10% of the company's market cap at announcement. In addition to this buyback, TKO is set to begin paying a quarterly dividend to shareholders, with $75 million in quarterly distributions anticipated to begin in 2025. Such a strong commitment to delivering value to shareholders in numerous ways, while continuing to grow the company's core businesses through acquisitions, is a good sign for the company's future, but we'll see how IMG and all these other businesses actually end up performing in the long run.
While I like the TKO business and the popularity of combat sports, like I mentioned earlier, I'm not very happy about the different businesses that TKO acquired from Endeavor.
And with that wraps up our 4th episode of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast as much as we enjoyed recording it today, please take a moment to like and subscribe on whatever platform you might be listening on, and especially share it with your friends who are interested in special situations or event-driven investing.